Hello fellow intelligent investors, my name is René Salman, and in this video I would like to discuss the concept of diamond hands, a term used across Reddit's WallStreetBet forum. And I will outline that I do think that having diamond hands, holding a position for the long term, is an appropriate investing strategy. But that in reality, most investors actually have paper hands and sell their stocks too quickly and too frequently. And I will back up this claim with a study that shows that Warren Buffett's favorite holding period, which is forever, has rather few followers these days, and that in fact the average holding period is at a record low. So without further ado, let's get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Salman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, maybe we should start off by briefly pointing out the origins of the term diamond hands. Well, Reddit's WallStreetBets forum has almost 10 million members now, and the number is still growing actually. And this community uses its own language. For instance, many of you have probably never heard of terms such as stonks, tendies, backholders, diamond hands, or to the moon, at least not in the context of investing. Most people that are starting to invest probably first come across, standard Wall Street vocabulary, which can be quite overwhelming at first actually. Many people are struggling to wrap their heads around terms such as equity, PE ratio, IPO, share dilution, return on investment, and so on and so forth. And by contrast, the terminology of WallStreetBets is much less challenging and makes the whole learning experience seemingly much easier. So we're not going to get into all of the aforementioned vocabularies of the WallStreetBets community, but we're going to focus on the two terms diamond hands and paper hands. Let's briefly define the two terms. Well, if you've got diamond hands, then you're an investor who's ready to hold a stock or cryptocurrency for a long period of time in order to reach a predefined goal, an end goal, regardless of any short-term risks or short-term volatility. And similarly, HODL is another frequently used slang term in the Bitcoin community in particular, and originated as a drunken misspelling of the word hold. And so it also describes the idea of holding onto a stock if a stock's price drops in the short term, as you believe in the long-term investment thesis. Now, on the other hand, if you've got paper hands or weak hands, you exit a position too early before realizing your maximum profit, because you couldn't stomach short-term volatility and maybe the heat of the individual situation of a specific company. Alright, now that we have a basic understanding of WallStreetBets terminology, let's consider to what extent investors actually stick to the diamond hands mantra. When you take a closer look at some of the threads on the Reddit forum, you will see that many members will point out where a business will be in 10 or 20 years from now when they discuss, individual stocks. So this implies a long-term investment horizon for the investment to pan out. And generally speaking, I would say I love that attitude. However, a recent Reuters article showed that the average length of time shares of individual companies spent in investors' portfolio actually hit a record low last year. In fact, the average holding period has been shrinking for decades, but the trend accelerated in 2020 as investors were trying to exploit the wild swings of, maybe early 2020 in particular, in order for a quick gain. So let's take a look at the cold hard numbers. According to Reuters calculations that are based on New York Stock Exchange data, the average holding period for US shares was 5.5 months in June of 2020, compared to 8.5 months at the end of 2019. And when we're looking at European stocks, you can spot a similar trend as the average holding period dropped from 7 months at the end of 2019 to around 5 months in June of 2020. And if we take a look at the graph, we can see that in the historical context, if we consider the average holding periods of stocks over the last decades, well, then we are truly speaking of record low numbers. If you go back 30 or 40 years, then the average holding period was measured in years and not months. In the 1940s, the average holding duration was 7 years. And you can also consider the following charts by the Bank of England that are maybe a bit dated, but they also illustrate how the average holding period developed on other stock exchanges over the years. And if we look at another metric, the turnover ratio, well, then we can spot a similar trend. Maybe for starters, the turnover ratio or turnover rate is the percentage of a portfolio's holdings that was replaced over a 12-month period. And according to Lipper Analytical Service, the turnover ratio of a group of global multi-asset funds increased from 85% to 92% in mid-2020. All right, before we move on, if you like my content, you could of course help me out a great deal if you could just very quickly hit the like button of the video, or even better, leave a comment. And if you are new here, be sure to subscribe to the channel if you want to become educated in stock investing. Thanks. All right, so based on the presented data, I guess the first major takeaway here is that having diamond hands is apparently a popular term among Redditors, but that the vast majority of investors actually does not stick to that mantra. Now clearly we are just describing a general trend and obviously have no data for investors engaging in the WallStreetBets forum in particular, but the data shows that investors, on average, are more and more short-term focused. And this obviously begs the question why that is the case. Well, I think there are various explanations for the short holding periods. Firstly, there seems to be an increasing level of speculation in the markets, as more and more people want to get rich quickly. In 2020, for instance, there were sports gamblers that were pretty much bored to death at home due to the lack of sports betting and the lack of sports events. And generally speaking, it seems like price discovery seems to be less and less relevant, which I discussed in my video on different types of valuation in different investors. And if people think stocks don't have a true intrinsic worth and that maybe determining the intrinsic value of a company is increasingly difficult because there's a lot of uncertainty regarding the economic outlook, how the pandemic will unfold, and future earnings of specific companies, well, they will naturally place more emphasis on short-term events and sell stocks after maybe an earnings miss or some regulatory issues or other short-term events. And especially uneducated wannabe investors who are not willing to do their due diligence, to spend time educating themselves, they often just start buying and selling stocks based on information that is maybe not related to the core of the business, not related to business fundamentals. And other factors contributing to high turnover ratios are certainly commission-free trading apps that are gamifying the investing experience and displaying bursts of confetti in their apps to celebrate successful transactions, which of course encourages trading behavior. And if you've missed my video on the gamification of investing, I will add a link to that video to the description box down below. And then lastly, there are trillions of dollars of central bank and government stimulus. And it seems like many people are simply throwing their stimulus checks directly into the market in an attempt to multiply their money. And if you combine this with the low interest rate environment we are living in right now, which certainly also contributes to more and more people starting to invest in stocks, as they are looking for ways to generate, any form of meaningful returns on their investments. Well, then you end up with lots of activity in the stock market. Obviously, we cannot pinpoint the exact reasons for the duration of stock holding periods to fall. And it's probably a multitude of reasons. But whatever the cause, ultimately, I think that the inability of investors to hold stocks for the long term will very likely harm their long-term investment returns. Not only is it impossible to predict or accurately predict short-term market movements or stock price movements, no, moreover, a high portfolio turnover rate indicates high transaction or trading costs, and therefore severely impacts the returns of investors. And so for the average investor, holding stocks for only a few days, weeks, or months will not lead to strong equity returns. Let me reference a study here. The study Day Trading for a Living by Delosso et al. And published in 2019. Well, the study examined almost 1,600 Brazilian day traders and tracked their activity for 1 year. The authors concluded that only 3% of the investors made money. And what the authors did here is they avoided to make claims about day traders' ability to make money in the short term, but instead focused on the long-term success of their day trading activity. And the authors concluded, we showed that it is virtually impossible for individuals to day trade for a living, contrary to what course providers claim. We observe all individuals who began to day trade between 2013 and 2015 in the Brazilian equity futures market, the third in terms of volume in the world. We find that 97% of all individuals who persisted for more than 300 days lost money. Only 1.1% earned more than the Brazilian minimum wage, and only 0.5% earned more than the initial salary of a bank teller, all with great risk. Generally speaking, I think as a private investor, it's pretty hard to compete with professional fund managers who spend 24/7 analyzing businesses and who have access to all sorts of research tools, research data, industry experts, and maybe also access to management teams. And that's why I think your main edge as a private investor is actually the willingness to take a longer term view. There's actually a term for this, time arbitrage, which refers to investors' ability to invest on a longer time horizon than most other people in the world of investing. In fact, I believe that the longer you extend your time horizon, the less competitive the investing game becomes, because most professional fund managers, well, they have a short-term view. They need to try to avoid short-term underperformance and thus volatility, and they have to avoid it at all costs. And basically all of the underlying incentives of the fund management industry, they make it hard for them to hold a business for many years and to consider what a business will look like 10 years from now. And Warren Buffett himself refers to this as the institutional imperative, which basically prevents truly long-term thinking. And Rob Rodriguez, longtime CEO of First Pacific Advisors, well, he once said, the advantage we have is time frame. When I came into the business, the average holding period for a mutual fund was 7 years. Today, it is less than 9 months. So you might think of WallStreetBets whatever you want, but the concept of diamond hands, the idea of analyzing the long-term prospects of a business, to buy the business at an attractive price, and to then sit still and weather any short-term price movements. Well, this strategy actually is quite compelling in my opinion, if you can execute it. However, most people can't. They place too much weight on short-term factors and how they impact a company, but not a company's longer-term, well, potential. In fact, I believe that the ultra short-term focus of Wall Street and the incredibly short holding periods can give those investors an edge that are willing to look beyond the market's, well, 3 to 12-month investment horizon. And just to stress my point here, let me quote legendary investor Bill Ackman. I think a big part of the edge comes from we're not going to do a better job predicting next quarter's earnings than people who focus on that. And we just don't focus on that at all. What we focus on is what is this business worth over its life. And the markets generally overreact to short-term information and noise, whether the stock is going to go up or down on the quarter. And we don't spend any time trying to figure that out. And that kind of activity, whether it's driven by quantitative traders or computers or fast money, so to speak, moves securities around occasionally to crazy prices. And that should already be it for today. May your finances and investments prosper. Good luck.